Hey there, listeners. If you enjoy this podcast even half as much as we enjoy producing it, show your support by subscribing and leaving a review. It really helps us keep those dividend checks coming.
This is Greg Dunweiler, and you are listening to another episode of the Dividend Mailbox, a monthly podcast about dividend growth. Our goal is to stuff your mailbox full of dividend checks. When they grow over time, a funny thing happens. You create wealth. Welcome to episode 50 of the Dividend Mailbox. In this episode, we're going to start out with a quick look at last week. The Wall Street Journal did a quiz for investors to see how much they know about the market. There's a few questions in there that we thought were very relevant to what we do. We'll hit those, and then we'll go into a new idea that we have. It's one that we've actually owned for a long time, but we have not put any new money in this thing for years. The market is constantly evolving, things change, and this company is back on our radar. So for those of you that think dividend investing is boring, this one has a major growth component to it, or it definitely has in the past. Before we do that, though, I want to go back to something we mentioned in the last episode. We offered to do a review of your portfolio based on how it stacks up to dividend growth from our perspective. Several of you took us up on it. And if you'd like to get a quick overview of your own portfolio, just email it to us. You don't have to include your dollar amounts, but we do need the stock symbols. It would help if you give us the weightings. Otherwise, we will weight it all equally. We'll rate it 1 to 5. And we'll send you a short report that highlights the big picture. Just remember, this is not a detailed recommendation. It has no reflection on how your portfolio may or may not perform in the future. It's just simply to help give you a few things to think about. So if you want to send a portfolio to us, email it to dcm.team@growmydollar.com. And with that, we will get into episode 50. To start this episode out, I thought we'd have a little bit of fun here. Just recently, the Wall Street Journal had a quiz to test your knowledge of the stock market. And I thought, I'll take this real quick and just remind myself of how smart I am. And lo and behold, let's just say I did not get a perfect score. But what I'm going to do is just give you a couple of the questions because they relate directly into what we've talked about in the past. And incidentally, question number 1 was, we're putting you in a make-believe time machine and sending you back a century to 1925 with $1,000. You have to invest it in one company, but you don't have to invest it immediately. You can hold on to it, and you can wait for decades if you want for the proverbial fat pitch. They gave you 4 choices. You can only pick one. The first one's Coca-Cola. The second one's Nvidia. The third one's Altria. And the fourth one's Apple. Well, technology has been on fire recently, so it's very easy to think, well, heck, Nvidia is the most valuable company in the world. It's crossed $4 trillion in market cap. Must be Nvidia. Well, actually, it's not. The answer is it's Altria. The thing that comes up is it's those dividends that accumulate over time that create all the magic. Just how well did it do? You could have put 1,000 in it in 1925. It was around back then. And if you would have held it and reinvested everything and held on to the spinoffs, your $1,000 would have grown to $3 billion. Now, I haven't verified this. I do know that it's been a really strong performer, but we're just going to trust that the Wall Street Journal is right. So all the dividends, they've spun off several companies, add all that together, and it's been a huge compounding machine. Even though Nvidia has the largest market cap, you got to remember something that pays out dividends over an extremely long term can surpass market cap. And then looking at their second question, it was, you may or may not know, actually, I had vaguely remembered this, but last June, there was a glitch on the New York Stock Exchange. And for a brief period of time, Berkshire Hathaway dropped by 99%. The question is, if you unfortunately sold on that glitch and you saw your investment decline by 99% and you had been in it for a total of 60 years from when Berkshire Hathaway first started trading as a public company, their questions are, would you have 95% less than people who just invested in an index fund? 90% less? Would you have half as much wealth? Or would you still have 40% more than an index fund investor? Well, the answer is because Berkshire Hathaway has actually returned 5.5 million% trading back 60 years ago. You're still way ahead of the index. Again, things on the surface are not always as they seem. Both of these questions, for the most part, had nothing to do with technology. Obviously, Altria is pretty much as far away from technology as you can get. Berkshire Hathaway, for the longest period of time, most of their growth record was built before Warren Buffett ever invested in Apple. So I just thought that quiz was just a great reminder of compounding and cash flow. But we're going to move on and we're going to look at how we're going to try to build wealth here in the future. And this definitely fits into long-term dividend growth. The company that we're going to talk about today is Accenture. It is the largest consulting firm in the world, actually by quite a bit. In full disclosure, this has been a personal holding since June of 2005. Performed relatively well for the last decade or more, but really never looked at it very seriously because the stock was always expensive. So I have not put any new money in it in quite a while. It is in some customers' accounts, but it's not a wide holding. However, the stock has dropped from the low 400s all the way into the mid 200s. And we'll get into this later. But the biggest reason, apparently, is that they do have some government contracts. They were one of the first casualties of DOGE cuts from the government's budget. It was 8% of their global revenue and 16% of American revenue. And then on top of that, AI has impacted some smaller consulting businesses. There's some fear that there's going to be some short-term weakness here. But one of the great things about this pick for this episode is they have a very wide, diverse business. We first bought it in June of 2005 for $23. And I have since received virtually the entire amount of my original investment in dividends. It has been a great dividend investment. You know, it started out at about a 3% dividend yield. And incidentally, this was purchased about the same time Microsoft was. It was a very similar 3% yield also. Both of these have had some really great dividend increases because their businesses have just been phenomenal. So Accenture traded up to a high of 400, a little above 400 about a year ago. And right now it has come back down to, currently it's trading about 239. So it's come down quite a bit, which has brought it down to a point where we get to talk about it because the current dividend yield is just below 2.5%. It's a little lower than what we like to try to buy, but it is in our, what we like to call sweet spot. And as you will see, it's probably not going to stay at 2.5% for very long. So one of the things that I must confess in thinking about this, as I have seen the price coming down, I read a comment, and this is the danger when you read comments in, I can't even remember where I read it. It might have been something in Barron's, but I could be wrong. But basically, it was the whole mention of AI and how consulting could be in for a rough go because AI just has the ability to come up with answers extremely fast for a lot of different topics. So naturally, in consulting, hey, is this going to be a problem? I was looking at Accenture thinking, it's come down. It's still more than 10 times what I paid for it. So even though it's come down a lot, I've had a huge gain on it. Maybe I should just take my money and run. Because if AI does have a serious impact on the business, it's probably going to go a lot lower. Well, I want to kick this off, and some of this I'm going to read word for word because it's hard to summarize this. I want to tell you right up front, Morningstar and Valuation, I'm going to refer to both of them. These are not the end all. However, it's always great to get a third-party opinion. It saves a lot of time and can make it easier. Well, Morningstar basically says Accenture is the only IT services company that has the capability to deliver end-to-end business solutions. If a brick and mortar bank is planning to launch a mobile banking app, Accenture is ready to assist it through the entire process, which includes overarching strategy design, IT system integration, custom application development, new service marketing, and digital infrastructure management. Without Accenture, customers need to sort different services from several suppliers, potentially leading to project delays and cost overruns. We believe Accenture's unique capability of providing integrated digital solutions across consulting and managed services boosts the company's image as a flagship IT services provider and reinforces its customer relationship with Fortune 100 companies. I mean, they go on talking about, for lower end services, AI potentially is going to have an impact, probably will have an impact. But on higher end services, which is pretty much where Accenture lives, AI, in their opinion, is potentially going to be better for their business because this can get so complicated. Tying it all together can be extremely challenging. That, in a nutshell, is Morningstar's opinion on Accenture's future. And just because it's not that long, I'm going to read Valueline's opinion. Valueline says, Accenture has a clear path forward with solid revenue growth opportunities over the long run. The business has been aggressively acquiring small companies to expand AI capabilities and financial offerings. Management is extremely bullish on AI due to secular trends. Accenture and Nvidia have partnered to build digital replicas of warehouses, enabling the simulation and refinement of automation processes with AI and robotics before real-world implementation. So I think that sums up that I'm not too worried about AI taking out Accenture's business. In fact, it could actually reinvent it. And lo and behold, if you go to Accenture's website, there it is. They've rebranded their business, and it's about reinvention. Just from that overview, we will now start to look at, okay, where's Accenture and why is it potentially a great long-term dividend growth investment? Well, let's start with what it's done. So you go back 10 years, the dividend has grown by 177%. Last I checked, 177 is a bigger number than 100, which is our threshold. Last 5 years, it's grown 76%. The dividend's grown faster than what we hope to get. We talk about this over and over, but in order to get dividend growth, you have to have a growing revenue company and earnings company. Well, earnings have grown in the last 10 years, 153%. Revenue has doubled in the last 10 years, and it's grown in 20 years from 15 billion to 65 billion. You've got earnings growth that's keeping up, and that allows you to keep growing the dividend faster. Revenue has grown also. So if you think you can't get a growth stock, here we are. Accenture, without a doubt, is a growth stock. In this case, dividend payout ratio was 43% 10 years ago. Right now it's 45%. That roughly is where it lives, fluctuates a little bit. We're going to get into the debt here in a little bit, but they, for all intents and purposes, have no debt. From that standpoint, there's no real immediate threat to any issues with the dividend. If you look at margins, remember that I said 20 years ago, revenue was 15 billion, now it's 65 billion. They've done that, and they've actually increased their profit margin. It's up to 11%. 5 years ago, it was 10%. 10 years ago, it was 9%. Gross profit margins, 32%. 10 years ago, they were 30%. So they've been able to grow the business and maintain the profitability. And that is a huge plus. If we look at shares outstanding, they really haven't done much as far as buying back stock in the last 10 years. They bought back a lot from 20 years ago to 10 years ago, but that's a little bit of a long story. The short version is Accenture was spun out of, I believe it was Arthur Andersen, right before they went Chapter 11. I believe they were involved in the Enron scandal, and Accenture was spun out. They had a bunch of a different class of stock that was basically given to management. So they bought back about half their stock, but most all of that was a special class. If by chance you go back and look at those numbers, it's not because they wanted to aggressively buy back stock. They just basically wanted to get rid of that class. They've been very consistent in how they've managed the balance sheet. They have $5 billion in debt, but they have about $10 billion in cash. They have zero net debt is the bottom line. And for all intents and purposes, they have not had any debt for more than 20 years. So you've had a lot of growth without debt and without issuing stock. They've done it all internally. You might ask, how could they do that? Well, when you have return on invested capital numbers that for years ran around 30%, and as the balance sheet got bigger, it did start to decline. So as the asset base grew from back in 2010, about 12 billion in assets, up to the last full year ending in 2024, they have roughly 56 billion in assets. They still have 20% return on invested capital. It's a very profitable business. And here's the more important thing, and I'm going to get to this next. One of the things that we always look for is the incremental return, meaning that as the balance sheet grows on that part of the business that is the growth piece, is the return of that as good as the core business? From Accenture's standpoint, since 2007 to 2024, which is a fairly long stretch, the incremental return on invested capital has been 20%. They have continued to be disciplined as they've grown the company. Now, here's something that is a little incredible because you don't see this very often. If you've listened to us at all, you know we are very leery of companies that do a lot of acquisitions. And in the case of Accenture, they have done a lot of them. I just read Morningstar and Valuation talking about how they continue to tuck in these small acquisitions. bringing in expertise in different areas for their consulting business. Well, in the most recent quarter of 2025, they have total assets of $63 billion. Of those assets, $24 billion is goodwill and intangibles. Stockholders' equity is $31 billion. Normally, if 77% of stockholder equity is goodwill, I'm extremely nervous. A lot of companies will have different degrees of debt, and a lot of them will use a lot of debt to acquire. Don't have that problem here. You just have the issue, well, do they dilute the balance sheet? We've already been through that. The answer is no. They've done a really good job integrating these businesses and getting the value out of them. So I think we're in good shape. Another way to look at these acquisitions, and one reason why there's been so many of them, this is back to their business model. Morningstar calls it a wide moat, and clearly the way Value Line talks about them, they have an extremely wide moat because the dividend mailbox can call them, ask them for some consulting help, which we're not going to do because we're not that big. But we can call them. United Health can call them to help straighten out their mess. The federal government calls them. Anybody in any industry basically can call these guys, and they can come in start to finish and help solve your problem. They are the only consulting company out there that can do that. And I think that's one reason why they've been able to hold their profitability through all these acquisitions. However, going back to the debt piece, one might ask, why do they even have any debt when they can pay it all off right now? I don't even remember when I first bought it if they had debt then, and I'm not even going to look because at that point it doesn't matter. But they have not had any debt for a long time. They issued $5 billion of debt in November of 24. You might wonder, well, why? I guess the other way to look at it is why not? They have $1.1 billion in 2027, 3.9% interest. $1.2 billion in 2029, 4.05% interest. They have $1.2 billion in 2031, 4.25, and $1.5 billion in 2034. That's at 4.5%. If you remember those profitability numbers that I talked to you about, if you're earning more than double, triple what your interest rate is, it sounds like you should borrow money all day long. But they've kept it pretty conservative, $5 billion again. If you look at total debt outstanding, the number's going to be a little higher than that, partly because they have $1.2 billion of letters of credit outstanding. And then they have another small commercial paper outstanding of about $100 million. Well, this is just a point to remember. If you got a company that's not doing very well and the stock's going down, and I just happened to look, it's like, all right, how is this debt trading? Is the market getting nervous here? I mean, if they're going to lose some government contracts, if AI potentially is going to have a major impact on the business of Accenture, this is a broad statement, so take it for what it's worth. Debt investors, institutional wise, they tend to be a little more sophisticated, or sometimes they're considered smart money. That's a broad term, and somebody will probably beat me up for that, but whatever. Usually the debt will give you an indication that something's not right. If they're starting to discount the debt, investors are truly getting nervous besides just momentum trades. If you look at the debt of Accenture, all four issues, the closest maturity trades at par. Next one's 99.6. Next one's 99.2. The farthest one out is 97.4. Par for a bond is considered to be 100, so these discounts are extremely small. It could be interest rates moving a little bit. It could be credit spreads changing slightly, but since Accenture is AA minus, I doubt that there's really any credit risk there. And now just to go a little deeper into quarter by quarter, just to see, all right, Is the business showing cracks here? If you just look at the gross profit margin, the quarter ending in December of 2024, it was 33%. You go back middle of last year, 33%. You go back to the end of 2023, 33%. 12/31/2022, 33%. So they've held margins very steady. Operating income in the quarter ending in December 2024, 17%. It actually has gotten a little bit better. You go back to 3/31/2024, it was 13%. September 2023, 12%. It was in December of 2022, 16%. It does fluctuate a little bit, but basically it has held very steady. So from that standpoint, I think we're in good shape. Another thing to just be careful with that I've learned over time, what they could do is go out and start bringing in some customers that are not as credit worthy. One of the ways you can pick that up is, okay, where do accounts receivable stand as a percentage of assets? Is the number growing, which would tend to indicate that they've got customers that aren't paying as fast? Well, if you look at December of 2024, accounts receivable of assets, 21%, that was the lowest number going all the way back to December of 2022. If you look back in December of 31, 2022, it was 27%. Average over that period was 24.5%. So all indications are that their customer base is as strong as it's been in the past. Looking at all the numbers, Accenture continues to be a well-managed, extremely strong balance sheet. In the near future, there could be a crack in some of these federal contracts, but we've seen where 8% of global and 16% of American revenue is in federal contracts. The reality is, as large and as complicated as the federal government is, and just large corporate environments in general, it seems highly doubtful that long-term the government's not going to need, if anything, as much or more consulting help as what they've had in the recent past. But that is creating a buying opportunity. It's already created one. And if it gets any better, I would continue to add to this thing. So with that, we will now move to why buy it? Why are we looking at it now? Well, I want to hit this again and we'll keep hitting it. The first place to start is our simple little 10-year model. Payout ratio for the last 10 years has averaged about 45%. And that's right about where they are right now. The dividend currently is $5.92. If this dividend grows by 7% a year, then in 2034, it's going to be up to just under $11. If the dividend's $11, and if they continue to pay 45% out, where do earnings have to be? Well, they have to be at $24 if they continue to remain at that 45% payout. How likely is that? There's no guarantees, obviously, but Value Line and Morningstar both put estimates out at 2029 that they're going to earn about $17. That's up from their current earnings through 2024 of $11.44. If they're on that track, they're in good shape because in order to go from 17 to 24 over the next 5 years, they only have to grow at 7% a year. The past 10 years, they've had annual earnings per share growth of 9.7%. So 7% should be extremely attainable. At a 7% dividend growth rate, and it's up to $11 in 2034, and it has a 2.5% yield, same yield as where we are now, without compounding, you've got a return of about 120% on your money. Value Line actually estimates their dividend growth through 2029 to be about 10% a year. If the dividend were to grow 10% a year out to 34, the dividend would be up to $14. 45% payout, that's $31. That means earnings have got to grow almost 13% a year. It's possible, but we're not going to bank too much on that. The good news is all we need is 7. Now, are we going to invest for this? No. But here's the potential upside. For probably a decade, the stock traded down in that range of about 1.5 to even below. It got as low as about 0.5% on the yield side. If you get a dividend of $11 in 10 years and the yield drops back down to 1.5% because AI has actually been a growth story for Accenture, the stock goes from 240 to 733. If the dividend does grow by 10% a year and it hits $14 in 10 years, if you have a 1.5% yield, the stock is 933. It's just simple math. We'll see. Again, it's not why we're pitching this story. But as I'm kind of thinking on the run here, why not go to a growth story? If Accenture actually does convert AI into a growth story for their more sophisticated clients, which you can only imagine how complicated it's going to be to tie all this stuff together. We think it's just another great dividend growth story to have in our portfolio. So back to why buy it. Usually the stock trades at a pretty high multiple. PE, it's usually above 30. The 5-year average has been 29. Right now, the stock trades at a PE of 19. The last time we've been below 19 was in 2017. Historically, the stock is cheap. If you look at price to sales, it's at a near 10-year low. And right now it's 2.2 times sales. It's down from over 4 in the last several years. From just simple valuation there, it's cheap. If you look at free cash flow, they have about $10 billion in free cash flow. The market cap right now is just below $150 billion. That is 6.7%. You have to go all the way back to 2012 to buy it at a free cash flow yield that's this cheap. That's the number we love to see, because really what that is, if you won the lottery, but of course there's no lottery large enough that could pay you enough money to buy the entire company. But if you could, you had $150 billion and you bought this company, you got $10 billion coming out in free cash. That's a 6.7% yield. And it's growing. Sounds like something I want to own. So, moving on, what can go wrong? Well, first of all, approximately 41% of their earnings come from their top 10 clients. So there is some concentration there. Then there is acquisition risk, but we've already addressed most of that issue. They have a good track record of acquiring and integrating. There's AI and technology disruption, but again, that's part of our story, why we think this is actually potentially going to be a positive for them. You could say there's regulatory and compliance risk. There's always the chance that, data privacy issues or having one company that's, I don't think you can use the word monopoly here, but clearly they are perceived to be the only real company that has solution from beginning to end for pretty much any company or government out there. Could that be potentially broken up? Possible. IBM's a big competitor, but they are pretty much more technology driven. I mean, those are probably the quick highlights. There's always risk, and a lot of times you just don't know where it is yet. So that's basically our look at Accenture. We think that a lot of the recent weakness has come from issues that ultimately will be resolved. We've had a somewhat small position in it for a long time. As I said, we haven't put any new money in this in years. It's back on our list. We are accumulating it. I will just tell you, It won't be a full position yet because we always like to leave room. There is headline risk there of short-term downside. And then there's always economic risk. But I will tell you, in the past, they have managed through recessions relatively well. You never have a perfect situation. There's always something. But in this case, we think with how much the stock has declined and what it's valued at right now and the growth prospects going forward, we think it's a prime candidate to be your 10-year hold or maybe longer. If you enjoyed today's podcast, please leave us a review and subscribe. If you would like more information regarding dividend growth or our investment strategy, please visit growmydollar.com. There you will find previous episodes and also our monthly newsletter. If you have any questions or anything to add to today's episode, please email Ethan, ETHAN, at growmydollar.com. Past performance does not guarantee future results. Every investor should consider whether an investment strategy is right for them and all the risk involved. Stocks, including dividend stocks, are volatile and can lose money. Dunweiler Capital Management may or may not have positions in the publicly traded companies mentioned herein.